Welcome to this explainer. When you look at a sprawling city skyline or a massive sprawling suspension bridge, you can't help but marvel at the sheer architecture of it, right? The careful planning, the load-bearing supports, the intricate design. Well, today, we're exploring an architectural marvel of a completely different kind, the Indian financial system. But we aren't just going to talk about it in vague, abstract terms. No, we're going to examine it as the highly structured, perfectly engineered machine that it literally is. To get us started, I want you to really think about this. What actually happens to your savings when they enter the financial system? I mean, when you deposit your hard-earned cash, it doesn't just sit in some static vault gathering dust. It instantly enters this incredibly dynamic network. It becomes the literal fuel for a massive economic engine that drives growth, funds businesses, and builds infrastructure. The big mystery we're going to solve today is exactly how that engine is put together. Okay, let's dive right into this. We've got this wonderfully detailed engineering note, drawing number IFM-DK-001, which details the overview of financial markets in India. Throughout this explainer, we're going to treat our source material exactly as it's presented, as a literal, verified blueprint of the economy. We are going to read the absolute schematics of how money moves. So here's how we're breaking it down today. First, the core engine. Second, Pillar 1, institutions. Third, Pillar 2, markets. Fourth, Pillar 3, instruments. And finally, number 5, the complete ecosystem. Starting with Part 1, the core engine. According to our verified overview, a financial market is basically the ultimate marketplace. It's where financial assets, think shares, bonds, currencies, derivatives, are traded. And over the years, the Indian financial markets have evolved dramatically. Thanks to insane technological advancements, globalization, and some really strict regulatory reforms, it has become this highly efficient system. Its main job? To seamlessly facilitate the mobilization of savings and the allocation of capital, making sure the whole economy just functions smoothly. Now, if you distill that core function down to its absolute simplest mechanical action, it's really just a transfer system. The engine operates by transferring funds from surplus units, those are the savers, the people or entities that actually have extra capital lying around, over to deficit units. Those are the borrowers, the folks who desperately need that capital to build, expand, or operate. That transfer, that is the fundamental heartbeat of the entire financial system. And this brilliantly illustrates exactly how that transfer is supported. The blueprint structures the Indian financial system into 4 load-bearing pillars. We've got Pillar A, financial institutions, Pillar B, financial markets, Pillar C, financial instruments, and Pillar D, financial services. These 4 pillars work absolutely in tandem to carry the immense weight of the nation's economic activity. For the rest of this explainer, we're going to deeply analyze those first 3 major structural pillars. Moving on to Part 2, Pillar 1, institutions. Our schematic lists 7 critical institutions, and we can actually fire right through them to see their specialized roles. At the very top, acting as the apex monetary authority, is the Reserve Bank of India, or RBI. Next, we have commercial banks. These guys handle your primary day-to-day deposit and lending needs. Then there are cooperative banks, which specifically target rural and semi-urban credit. And notice how hyper-specialized they get? Take NABARD, that stands for the National Bank for Agriculture and Rural Development. They focus purely on financing rural growth. SIDBI does the exact same thing, but for small and medium enterprises, throwing vital funding to small businesses. Then you have LIC, the Life Insurance Corporation, handling life insurance and gathering up massive long-term savings. And finally, mutual funds, which act as pooled investment vehicles to gather a bunch of smaller savings into massive market forces. Every single one of these has a distinct, carefully engineered purpose. Part 3, Pillar 2, markets. As our blueprint defines them, financial markets are the actual platforms where these financial instruments are traded between buyers and sellers. The schematic breaks this whole thing down into 4 distinct market types, and each one is engineered for a very different kind of transaction. Let's compare the first 2. You've got the money market and the capital market. So the crucial point to remember here is the timeline. The money market is built entirely for short-term funds. We're talking anything up to 1 year. If you need liquidity and you need it fast, this is exactly where you go. The capital market, on the other hand, is built for long-term funds and securities. This is where companies raise money for those massive projects that will literally take years or even decades to complete. Then, the remaining 2 markets serve incredibly specialized functions. The foreign exchange market is all about cross-border currency trading. It is exactly how global trade is facilitated. Contrasting that is the derivatives market. Now, this isn't necessarily about raising new capital. It's a market specifically engineered for trading risk management instruments. It basically allows participants to hedge their bets and protect themselves against wild future price swings. Part 4. Pillar 3. Instruments. Financial instruments are defined here as the actual documents or contracts that represent financial claims, and they are highly varied. You've got shares, which represent a literal ownership stake in a company. Then you have debt instruments, like debentures, which are long-term debt issued by companies, and bonds, which are government and corporate debt securities. Now, if you need short-term tools, the system uses treasury bills for short-term government borrowing and commercial papers, which are basically short-term promissory notes used by corporations. Now, what's really interesting is this classification matrix. Just like a good mechanic would meticulously organize their parts bin, this system neatly categorizes every single instrument. You can see they're separated by equity, like your shares, versus debts. And then that debt is further divided by time horizons into long-term, like bonds and debentures, and short-term, like T-bills and commercial papers. They even have a hybrid category for complex tools like preference shares. It is perfectly organized to ensure that the absolute right tool is available for the exact right job. And finally, Part 5, the complete ecosystem. When you step back and combine all these structural pillars, the diverse institutions pooling the money, the distinct markets providing the trading platforms, and the specialized instruments acting as the tools of the trade, you get this perfectly engineered system. They all work in complete, flawless tandem. The entire mechanism is designed to mobilize savings right out from under mattresses and idle bank accounts, allocate that capital straight to the businesses and projects that need it, and ultimately ensure the efficient, continuous functioning of the broader economy. So we've unpacked the drawing, we've traced the lines, and we've seen exactly how the machine operates. But it leaves us with one final, absolutely vital thought to ponder. Looking at this massive, brilliantly complex financial blueprint, where exactly do you and your savings fit in? Because without the surplus units fueling the engine at the very beginning, literally none of this architecture stands. Definitely something to think about the next time you make a deposit. Thanks so much for joining me on this explainer, and keep learning.